Welcome everyone to this Wednesday edition of Inside India. I'm Sri Jegarajah. Your headlines. We are 1 hour away from President Trump's higher steel and aluminium tariffs taking effect. Investors so far are taking it in their stride. Most Asian markets trading higher. OECD lowers its outlook for global growth, including India, but the South Asian country is still expected to hold up better than the rest. And the Reserve Bank of India kicks off its policy meeting today. The wide expectation is for another 25 basis point cut. We will get the view from Goldman Sachs. Right, let's take a look at these Asian markets. And as we said in the headlines, trade uncertainty is starting to rise once again. And the markets are really bracing for higher US duties on steel and aluminium possibly. So time is running out in terms of a compromise in those negotiations. TAIEX is up, though, by more than 2%. The laggards seem to be in Southeast Asia. But there's nothing disastrous going on here. Straits Times is off just fractionally. Malaysia is flat and Thailand is down. It's a loss leader at this point by about 0.7%. India's markets join us in about 45 minutes' time. Let's give you Gift Nifty futures. And they are implying an opening number in the region of 24,718. So that would represent, compared to where we left off yesterday, about 200 points or so to the good for the benchmark. Let's give you the exchange rate. Dollar rupee sitting at 85.6590. Now, the latest round of US tariffs on steel and aluminium are due to come into effect in just under an hour from now. The 50% tariff applies to all raw metal and manufactured goods coming into the United States. The President claims that the import taxes are necessary to protect the domestic industry from foreign dumping. The United Kingdom is currently exempt from this round of tariffs due to the previous deal struck with the Trump administration. However, the OECD says Trump's trade war is weighing on the global economy. The organisation revising its global growth outlook downward to 2.9% this year from 3.1% prior, and warning growth could be even weaker if protectionism increases further.
The context is the significantly increased economic and trade policy uncertainty, tighter financial conditions, lower business and consumer confidence, and the impact it has on investment and activity that we're observing, which has led to this downgrade in our economic growth outlook.
OECD also outlining a moderate growth rate for India over the next 2 years at 6.3% for 25-26, 6.4% for fiscal 26-27. OECD says interest rates should continue to decline, but overall exports could slow, related to the overall pressure on the global economy outlined by the barriers to growth from the tariff implementation. Domestically, the OECD sees private consumption ticking higher, driven by higher incomes, an inflation rate of around 4% and a strong labour market. Right, let's turn the focus towards India and the consumer and bring in Anand Ramanathan now, partner and consumer industry leader at Deloitte. He joins me here at the SGX. Anand, welcome to the programme. Let's start with the macro picture, because India's consumers are not monolithic, are they? Consumption is hyper-local, it's highly diverse and complex. But what can we say in broad terms about the consumer segments that are emerging as winners and losers?
Sure. I think if you were to look at segments, we see the home and housing sector really do well the past few years. A lot of people have taken EMIs and they've invested in the second house, which is outside the city and a lot bigger. And hence premium housing, anything to do with that, fixtures, building materials, that's a space which will do well. And in fact, we've seen urban growth kind of dampen because of some of these EMIs, right? And therefore, the spend is going to shift from a discretionary spend.
Sorry, Anand, for our viewers who may not be familiar, EMIs being?
It's your monthly installments, right, that you pay on loans. And hence, when you take big loans, there are installments that you pay every month. So that's the EMI.
Understood. And if consumer demand is a barometer of the broader economic confidence levels, how robust do you think the current rate of growth is amongst the consumer, and is it consistent with 6.5% headline GDP, or are there signs of any softness?
I think consumption is fine. In fact, if at all, it's looking very good. We are seeing green shoots when it comes to the rural economy. Consumption in the rural economy is expected to further strengthen with a normal monsoon, and hence we'll probably even see double-digit growth in consumption when it comes to rural markets. Vis-a-vis urban markets, where there is not a slowdown, but consumption is somewhat dampened post the high levels that we saw after the pandemic.
And it's interesting you mention the momentum amongst the rural consumer. The RBI decision is just around the corner. And part of this feel-good factor towards the Indian markets and macro story really seems to be inflation trends that are looking more favourable given the monsoon rains. Is this why we are seeing renewed confidence amongst the rural consumer, and can it last?
I think there's a productivity improvement when it comes to agriculture, and that's helping from a food inflation standpoint. And we will see that continue to strengthen because there is a lot of investment that's going on at both the central and the state levels on agriculture, right? And therefore, food inflation is not going to be a big concern for the next few quarters, especially if there's a good monsoon. Having said that, there's also a lot of import substitution, which is happening in oilseeds and pulses and these kind of areas, which will also have a beneficial impact when it comes to food inflation. And I think demand looks strong, and hence 6% plus projection looks reasonable, right? You'll continue to see rural demand, and urban demand should strengthen.
In terms of the risks, what could go wrong? When you look under the hood at some of these fintech platforms, buy now, pay later, and this broad theme of the financialization of the Indian consumer, are there signs, Anand, that household debt perhaps is becoming problematic and perhaps may put the brake on consumer spending?
I think interest rates will soften on house loans, so there will be some benefit from that going forward. But having said that, I think there's still this whole middle income opportunity, right? There are about 100 million households which are going to move from lower income to middle income, right? So these are, when I say middle income, it's households with income between 3 lakhs to 30 lakh household income, right? And hence that will stimulate demand, and we will see most mass segments grow robustly. And beyond that, I think even premium demand, we're seeing a lot of premiumization in the economy across categories, whether it is consumer durables or auto, even fast-moving consumer goods. There's a lot of premiumization which is happening, right? So that will again help from a price growth standpoint, even if volumes are under pressure.
And how then do you see the pricing environment evolving, especially among the top quick commerce players? And if competition is so intense, then does anyone really command pricing power? And is this ultimately then a buyer's market?
See, I don't think quick commerce has yet played on price. If you see where quick commerce demand is coming from, it's coming from our urban metros, from people and segments who seek convenience, right? And hence the entire opportunity around pricing and building value through quick commerce is yet to play out in the market. Having said that, I think we will see some bounce back of physical retail too. We are seeing that in tier 2 cities especially, where physical retail, the large modern format stores, the large format stores are making a comeback, right, in terms of same store sales growth. So in the near term, I think quick commerce will grow, modern trade will grow, and therefore you will see that pricing per se will be less of a challenge, and it will be more around distribution and penetration. But the only difference is there'll be a shift from the brands, the large brands, to D2C and private label, right? Because the consumer will seek value, and there's more experiment seeking and experience seeking amongst younger consumers, which will drive D2C and the long tail of private label.
And DTC is proving quite a disruptive force amongst the established FMCG players. And let's talk about foreign competition, multi-brand retailing. And it's very interesting to note that Walmart-owned Flipkart is now returning to India, returning to its roots, if you will. They've got their eye on an IPO too. How do you think that's going to shake up? the landscape?
Sure. So specifically, I think the marketplaces were a little late to realize the potential of quick commerce, right? And therefore, you had a lot of smaller players actually open up the segment and build, at least change behavior in that segment. So you will see the marketplaces over a period of time gain from their traditional strengths and size to deepen presence in the quick commerce space, right? So I think going forward, it is going to be a good category which will see some consolidation because it's not possible to have so many players in the market, but it'll probably play out regionally and it'll play out differently in different parts of the country, right? But you will see some consolidation which will happen and a shift towards the bigger marketplaces.
And it's interesting that Flipkart are ramping up the hiring and the innovation engines for their quick commerce platform, Flipkart Minutes. Are they going to be successful, and will they emerge as best of breed, or are they a little bit late to the party?
See, the two things which determine success for quick commerce is scale, right? The more number of dark stores you have closer to the consumer, the faster the delivery is, and therefore the faster the growth will be, right? And hence, deep pockets of investment and access to capital will really determine success in the quick commerce space. So having said that, I think we will see the marketplaces do much better than the smaller players.
Commerce Minister Piyush Goyal has been absolutely categorical and has ruled out the entry of multi-brand retailing in India for fear that these huge enterprises can muscle out the mom-and-pop kirana stores. Is there a policy approach that perhaps combines the two and that can support both?
I think there's benefit in both sides, right? When you have multi-brand retail, you also have technology coming into the entire space. You have access to foreign capital, plus best practices that have worked elsewhere comes into the retail system and therefore builds some efficiency and brings down prices for consumers. But having said that, retail is a very big employer. After agriculture, it's the largest employment generation opportunity in India, and therefore multi-brand retail needs to coexist with the kirana and mom and pop stores, and our own projections say that mom and pops will continue to be relevant. Even by 2030, about 2/3 of the market will be the mom and pop stores, right? So I think there's space for both modern formats as well as traditional kirana stores.
Is there a way in which the kirana stores can survive and maybe even thrive, for example, by partnering with quick commerce as mini warehouses or distributors with local knowledge of smaller rural communities, which is clearly where the growth is, as we discussed, and partner along the supply chain? And I know we're going to have a discussion about the challenges in the cold store part of the supply chain, which is another issue. But do they have a role there in partnerships?
See, I think distribution-led businesses, especially for fast-moving consumer goods, will continue to depend on kiranas, right? But they have their own challenges when it comes to the second generation wanting to come into the business, right? But having said that, they are also modernizing. There's a lot more of self-service and convenience which is being provided by walk-in mom-and-pop stores. And there's door delivery which is being given. Plus, there's credit, right? In India, especially when it comes to middle-income and low-income households, credit is really important when you buy your food and other staples, right? So that is the niche that kiranas serve, and hence technology can make a difference, right? If you are able to carry stock which is relevant and turn it more often and build up these linkages on the supply chain. You mentioned cold storage specifically. There is a lot of infrastructure that's being provided by both the beverage players as well as frozen foods and ice creams and all of these different kinds of players, right? And that will help enhance the cold chain delivery at the last mile, right? But there are challenges on the supply chain, but given the agricultural investments that are happening, some of this will get plugged over the next few years.
Quick commerce fundamentally is popular, but it's not profitable yet. Underlying unit economics are not particularly compelling, and it's becoming a crowded space. So how do they make the margin?
So when it comes to quick commerce, what we're seeing is that it's going beyond food and grocery, right? For example, phones are being bought, gifting articles are being bought, consumer electricals and appliances are there, right? So I think category expansion is one important route to profitability. And the second is also to look at organizing unorganized spaces, right? So plastic goods, looking at selling currently unorganized categories, right? Private labeling them and selling it through quick commerce is the other opportunity. And private labels have been the route to profitability for most retailers in India, right? And therefore, quick commerce is not going to be very different. And the last step is obviously bringing in the scale advantages, right? As you expand beyond the metros, can you change behavior in tier 2 cities? Some of the tier 2 cities are looking good for quick commerce, especially they're building on where food service has captured some of those markets, right? And therefore, quick commerce is building on that. Hence, these would be the critical areas of focus from a quick commerce standpoint in terms of path to profitability.
Just how intense is the competition among the top players like Eternals, Blinkit, Zepto, Swiggy's, Instamart, and can they coexist, or ultimately, like Highlander, can there only be one or maybe two major players? What are the prospects for consolidation on the horizon, Anand?
I think consolidation is inevitable. It will happen. But however, what's happening now is there are regional strengths for each of these players that you've mentioned, right? And therefore, given their regional strengths, each one of them will deepen their presence in different parts of the country. And therefore, you will see some consolidation happen in different regions, right? And over a period of time, like retail in a broader sense, you will see consolidation in quick commerce too.
Operational challenges. Kiran Kart, Zepto's parent company, had its license suspended in Maharashtra by the FDA there. There were some very disturbing reports of fungal growth, improper storage, inadequate cold storage at its Dharavi warehouse in Mumbai. Does it look like these operators are putting speed before safety?
I think food safety is important and regulations are evolving when it comes to this space, right? And hence, we will see a lot of innovation which happens when it comes to quality, when it comes to managing expiry, also looking at ethical concerns in this space, right? There have been instances where startups need to be better governed, right? So we will see tightening of all of these different areas when it comes to food safety, quality and governance. And like any other emerging sector, the regulations are trying to keep in step with some of the dynamics in the marketplace.
It's really interesting to see how the established incumbents have responded. So Reliance have brought back Campa Cola from the 70s, right, with the Reliance signature disruptive pricing. And then there's the threat from DTC to the FMCG incumbents. Is this an opportunity? If you can't beat them, join them or buy them out. In the case with Hindustan Lever and skincare startup Minimalist, are we going to see more marriages of convenience like this?
Definitely. We will see more M&A. Given the competition in this space and given the changes in consumer behavior, you will see D2C brands and private label brands chip away at the larger players. Typically, if you looked at FMCG, the top 2 to 3 players used to have the monopoly in that segment, right? But some of that is going to change now. And hence, it takes time. The consumer is also evolving. They seek more experiences. So you need a wider portfolio, and it takes time for R&D to grow organically, right? And therefore, inorganic M&A is the way forward to stay relevant in most categories, and you will see the larger players acquire more D2C brands and smaller regional players.
And we'll wrap it up, but just before we go, leave us with a number. Morgan Stanley thinks that quick commerce is going to be a $57 billion opportunity by 2030. Does that sound right to you?
That sounds reasonable. In fact, it's quite realistic. It can be a lot more if Tier 2 really takes off, right, beyond the metros.
Anand, great talking to you, sir. Thank you very much indeed for joining me on Inside India.
Thank you for having me.
Brilliant conversation. Anand Ramanathan there from Deloitte. Coming up in the programme, South Korea looks to a new dawn under a new president after months of political uncertainty. Will be live in Seoul after the break. South Korea has a new president, and Lee Jae-myung has pledged to bring the era of divisive politics to an end. The markets are liking it. The Kospi up by 2.5%. Sherry Kang is live for us in Seoul, but President Lee has an uphill struggle, Sherry.
I agree with you. I think it's a tall task trying to achieve some kind of a political unity in a country that is deeply divided. And you look at the numbers of the votes. I mean, yes, he is a winner. He did win 49.4% of the votes. But if you combine the numbers for the two conservative opposing candidates, it's about the same number. So it is an election. Whoever wins, the other half would have been unhappy. And we got that result going. So going forward, it could be a very difficult task. But I think pragmatism seems to be the key word in his inauguration speech just in the couple of hours ago. And sure, that needs to be the message, given the fact that South Korea has gone through a lot of political uncertainty, the martial law, impeachment, and impeachment of the acting president. You remember what the country went through. So I think that is what he is trying to go for. Pragmatism is what he highlighted in terms of his policy pledges going forward as well. I thought it was interesting that he said he's going to borrow ideas from former presidents like Park Chung-hee or Kim Dae-jung. So we're talking about former presidents with a controversial but very strong presidential legacies. And I think that's what he wanted to go for, that he could be flexible, and that could be something that could work in South Korea that is ideologically divided. When it comes to the markets, you mentioned a bit of a rally going on in South Korea. I think that makes sense because there was a very pro-market message in the inauguration speech as well, that he said he would be pro-market, he will be, once again, pragmatic, and I think that's what the market is reacting to. And quite interesting, Sri, for the last several years, since 2010, I should say, there have been 3 presidential elections, and there has been every time a honeymoon rally. So the Kospi rallying by close to 2% in the first month. So we'll see if this presidency brings the similar level of a track record. And of course, the things are lined up in terms of the central bank put and some narrative around Asia repatriation flows as well.
Sherry, there are external pressures that President Lee has to deal with as well, and he has been he's self-described as a pragmatic diplomat. Is that a hint at the direction that Korea's foreign policy is going to take under him?
Yeah, so he could want to become a pragmatic leader, and I think that is a beautiful idea, but would it be easy to put that into practice? I think that's going to be really the question. He wants to be pragmatic, given the security alliance with the United States and commercial relationship with China. So I think that has been really the ambiguous stance that South Korea has been going for and has been, quite frankly, enjoying. But I think things could be a little bit difficult for that pragmatism in 2025, but we'll see how things go here. I think some lines coming out of the inauguration speech that suggest that he is going to work on South Korea's defense. He said, peace achieved at a higher cost should be better than a war. So I think that clearly reflects this geopolitically jittery times. And I think, in my very personal opinion, this is quite unusual line for day one for a progressive leader. So maybe it is a good example of his pragmatism. We'll see how things go. Local media seems to suggest that there will be a phone call between Lee Jae-myung and President Trump. So we'll see what kind of conversation they end up having as well. Sri?
Sherry, great coverage. Thank you very much indeed for that. Moving on to corporate news in Japan, shares of Toyota Industries falling sharply after the latest privatization reports. Lin joins us. And Lin, it's interesting, isn't it? Because under a privatized model or more private ownership, that would mean more influence by Akio Toyoda. Would more Akio necessarily be a bad thing?
Well, that is the key question here, Sri, because keep in mind, he is the grandson of the founder of the whole group. This is, you could arguably say, the most successful company to come out of Toyota. I mean, I did speak with Mio Kato, who is a researcher out of Japan on Japanese stocks, and he took this view. He said that whilst he feels that if you look at the price here, the valuation is arguably on the lower side, particularly because he sees significant upside to Toyota Industries' forklift business in the coming fiscal years, that he sees that this change in terms of corporate governance is ultimately a good thing, and a good thing for longer-term investors into the group, because we know that Industries has been facing some pressure from the activist investor here, privatizing Industries, which, keep in mind, is a key supplier of auto parts at a time when the auto sector is facing a high degree of uncertainty as well as technology disruption, means that the broader group can now make longer-term investment decisions without having to necessarily answer to these activist investors as well, Sri.
Lynn, thank you very much indeed for that. Inside India is taking a short break. We're back in 2 minutes. We are counting down to the market open in India, and this is how we are shaping up. Let's take you to the futures picture. GIFT Nifty futures pricing in an opening number in the region of 24,725. So that would represent a lift of about 200 points or so at the open. Not too shabby. Dollar rupee exchange rate at 85.72. A large part of what the market is going to be watching is the RBI. Reserve Bank of India kicks off its policy meeting today with a decision due on Friday. The broad expectation is for the central bank to lower its benchmark repo rate by 25 basis points, which would be its third straight cut. Let's get more with Santanu Sengupta, Chief India Economist at Goldman Sachs. Santanu, thank you very much indeed for joining me on Inside India. Is there a non-trivial risk that the RBI could supersize this rate cut this week and go for a 50-pointer?
Right. So our view is of a 25 basis points rate cut on Friday. The situation where the RBI could consider a 50 basis points rate cut is if it thought that it could deliver more than 50 basis points in the cycle further, which means that the total amount of, or the total quantum of rate cuts in the cycle would be in excess of 100 basis points. Our view is that the RBI will cut twice more, once on Friday, 25 basis points, follow it up with another 25 basis points. So unless they really have clarity on easing more than 50, doing a 50 basis points easing on Friday seems unlikely to us. If you just quickly look at the growth inflation picture also, while inflation is low currently, GDP growth number, which came in last week, surprised consensus to the upside. And therefore, that growth inflation mix might also prevent them from going for 50.
Exactly. And 7.4% really surpassed expectations, doesn't it? So do you feel that on balance, Santanu, this week's decision by the RBI and any clarity that they give us in terms of forward guidance is going to be largely neutral for Indian bonds, the rupee and stocks?
Well, the market is pricing in a little over 2 rate cuts from here. Remember, in India, financial conditions ease not just through the repo rate channel, but also through liquidity. And the RBI, apart from easing repo rates twice already by 50 basis points, has done a great deal on easing liquidity. It has been through a combination of OMOs, through repo operations, through FX swaps. And effectively, in our view, the RBI has delivered more than 100 basis points rate cuts already, just with 50 from the repo. Because if you look at the overnight rate in India, it was trading at around 690 in mid-January, which is now around 575 or 580, which is about 20 to 25 basis points below the repo rate. So from the market's point of view, as long as liquidity is easy, they will perceive this as a guidance for further easing if they deliver 25 basis points and keep the guidance dovish.
Understood. Santanu, can I circle back to what we were discussing earlier, and that was Friday's Q4 GDP print, 7.4%. Do you feel that the RBI this week, on balance, is going to look through the seasonality that was associated with that number and the one-offs relating to a spike in tax revenue? Or is it going to be a consideration?
So there are 2 ways of looking at the growth numbers in India. One is GDP, which you correctly pointed out, got a boost from the net indirect taxes. It was more than the tax collection. It was more the subsidy payout was lower in that quarter, which sort of boosted the net indirect taxes, which got GDP number to 7.4. But remember, on the supply side, on the production side, GVA, or the gross value added, also came in above market expectations at 6.8%. That is a pretty solid number. The RBI will, in our view, take note of that number, which means that you've already met the 6.5% CSO, or the Statistical Office's advanced estimate target, and this will be pretty good from the RBI's point of view. In terms of going forward, the one-off that you really had in that quarter, in our view, was the government capex. That came in very, very strong. It was backloaded. So effectively, the economy got a fiscal impulse, which was positive in the back half of the previous fiscal year. That, in our view, will not sustain in the first half of the fiscal year. But we are still looking at a number north of 6% for the year.
Yes. That's another conversation as to whether that public sector capex can really crowd in private sector capex. We'll get onto that later, Santanu. But part of this feel-good factor associated with the Indian macro and the market's narrative really seems to be down to benign inflation trends. We're looking more favourable because of the monsoon rains. I was speaking earlier with a guest on the programme about renewed confidence amongst the rural consumer. Does this all point towards inflation expectations being far better anchored than they were before? Or is this all lulling us into a false sense of security on the inflation front?
No, our view is that inflation, after a long time, will remain benign, at least for the next couple of quarters. Especially food inflation. You pointed out a good monsoon and a good crop. I'll just point out that the winter harvest, we are being told, is quite good. So if you have a good winter harvest and then you have a decent monsoon, which means that the summer harvest also can be good. Broad-based, you'll see better production and therefore lower inflation. The part which you cannot really forecast is what will happen to perishables or vegetable prices or let's say fruits. But even if you bake in some spikes in those items, we think that inflation will remain around, the headline inflation will remain around 3.5% for the rest of the calendar. Going into the next calendar year, the first half, is where we again see inflation going back towards 4% and thereafter 4.5% as you head into Q2 of the next calendar year, given the very low base of this year. But I would say that inflation is low for the next couple of quarters. That we are also seeing as a real income boost, especially for the rural economy and the mass consumption.
That said, Santanu, let me present the counterfactual. Are there signs of household debt becoming problematic and perhaps putting the brake on consumer spending?
Household debt was elevated last year already, but we do not think household debt has gone any further higher. Remember, the RBI came in with macroprudential tightening on, especially on consumer credit, in November 2023, and thereafter throughout 2024 you have seen consumer credit growth come off from about 25% odd towards early double-digit numbers. So overall credit growth from the banking system has come off from about 17% towards 11% or so. That has reined in the build-up that you are seeing in consumer credit. So the unsecured segments have already been taken care of from the macroprudential tightening. The question is whether you can get credit growth accelerate towards what you had in the 2 years back. We don't think you're getting there, but we think that the peak drag from credit that you had is already behind us.
I wanted to ask you about that, but just before I do, liquidity is getting to the parts of the economy that need grease on the wheels, are they, Santanu? And can the RBI afford to step back, or do they have to keep up the liquidity provisions on that score? And just give us a bit more colour on credit growth and the velocity of lending and whether it's consistent with headline growth in the region of 6.5%.
So firstly, on liquidity, as I said earlier, the RBI has done a lot on liquidity already. We don't think that they need to do more right now, either in terms of OMOs or in terms of repo operations or FX swap operations to inject liquidity. And the reason is because they have paid out a sizable dividend to the government. It's 2.7 trillion INR, and that was in line with our expectations. That will come through into the banking system and keep liquidity conditions benign for the next few months. Thereafter, in Q4, if required, our view is that the RBI will inject further liquidity. Remember, for monetary policy transmission in a cutting cycle, liquidity needs to be benign, such that the overnight rate or the effective rate of transmission of monetary policy is below the policy repo rate. So that's on liquidity. On the credit, we look at it from a more holistic point of view, which is the overall credit in the system, which is both banks, bonds in the onshore market and offshore bonds. I would just say that given the tightness and liquidity conditions last year and the macroprudential tightening from the RBI, you had a lot of NBFCs and corporates go to the offshore market to borrow in dollars. We see some of that trend probably changing with domestic conditions becoming benign, and some of that borrowing will probably shift to the onshore markets.
Yes. Santanu, just give us a read of what you have penciled in for FY26, because I was speaking to Nomura Sonal Verma not too long ago. She's not particularly optimistic. She's got 5.8% for FY26. And a lot of people are telling me keep an eye on the external situation. Has the potential for external shocks and the spillover into India been fully laid to rest? Are they less of a risk now to the Indian macroeconomic picture?
So in terms of growth, we are looking at 6.2% for fiscal year 26 after 6.5% in fiscal year 25. The reason is because the world is going to be slower going forward. And therefore, in this situation, we don't really see India growing materially faster than what we have delivered, what India has delivered in terms of growth in FY25. In terms of external shocks in the system, we look at it from the U.S. policy uncertainty impacting investment decisions of firms. So if you look at that relationship, and we have carefully looked at it in the past, we think it's going to be a significant drag on investment growth. We think that for one standard aviation shock to that uncertainty, you can have close to a percentage point decline in investment growth, which is what we are baking into our forecasts. Yes. Which means that policy uncertainty declines by the end of the year. You can see a recovery in investments either in the back half of this fiscal year or in the first half of the next calendar year.
Can India stick with the narrative of fiscal discipline and continue to target fiscal deficit of 4.4% of GDP for the current fiscal year? And what potentially could challenge that? Could it be a commitment to increase defence spending, given what we saw with the flare-up between India and Pakistan?
We have seen India sticking to the fiscal consolidation path over the last 4 years or so post-pandemic. And every year, the government has over-delivered on the fiscal consolidation by anywhere between 10 basis points to about 30 basis points. We think that going forward, they will be able to consolidate the fiscal deficit by 40 basis points, from taking it from 4.8% of GDP to 4.4% of GDP. If there's incremental spending required on the defense front, our sense is that it will be more of reallocation of capital expenditure that will go into defense, rather than increasing the deficit to meet the defense spending targets. But at this stage, we feel that the government will stick to the fiscal consolidation path and target 4.4% of GDP.
Understood. Nearly 14 out of every 100 youths are unable to find work. This is according to recent NSO data. How does the government fix that picture? Because there seems to be something of a dichotomy or a decoupling between a relatively robust rate of growth and job creation.
Undoubtedly, I mean, the government needs to basically look at it from all different aspects. India is not really a manufacturing or a services only story. Our sense is that we need to deliver on both. There needs to be further progress that is already, some nascent stages of progress in manufacturing can be seen, with especially mobile phone production happening in India. That needs to ramp up. Whereas on the services side, especially in services exports, India has done a great deal in terms of ramping up on the global capability centers, or GCCs. They are about a $65 billion market today, about 2 million jobs there. That needs to grow further. So that can be a combination then of higher end, higher paying jobs, as well as the more middle income jobs. Yes. And for that, reforms are necessary to propel growth forward and increase the potential growth of India.
Ultimately, Santanu, how viable, how achievable is Viksit Bharat policy to elevate India to developed status by 2047, which would require, we know, sustained economic growth of close to 8% every year for at least a decade? Is that achievable?
Look, our sense on potential growth in India right now is around 6.5%. We think with certain reforms, especially increasing the labor force participation rate in India, as well as increasing capital allocation, we can increase the potential growth rate by about a percentage point, which means that from about a 6.5%, you can head towards a 7.5% if you undergo these reforms and be able to increase the LFPR for especially for women. If progress is made on that front, we think that India can sustainably grow at 7% plus. But right now, we think the potential growth in India is in the region of around 6.5%.
Santanu, we'll leave it there, sir. Thank you very much indeed for joining me. Santanu Sengupta there from Goldman Sachs. Now, markets in Mumbai just coming online. We'll bring you those early movers when we return in 2 minutes. Welcome back. Indian markets are up and running, and the benchmark Nifty 50 is ticking just modestly higher to the tune of about 0.3%. We're at 24,610 or thereabouts. Dollar-rupee exchange rate at 85.8760, and the rupee is therefore weaker, just fractionally by about 0.2%. Let's take a closer look at some of the movers in the Indian markets today. A series of block deals to tell you about. Hyundai Motor and Kia Corporation have offloaded their entire stakes in India two-wheeler maker Ola Electric, worth about 6 billion rupees and 1.4 billion rupees respectively. Reports also indicate that private equity firm TPG will sell its remaining stake in Tata Technologies, and CA Dawn Investments, an affiliate of US-based Carlyle, may sell a 10.2% stake in healthcare tech firm Indegene, valued at about 14 billion rupees. Also tracking shares of Yes Bank at its board meeting on Tuesday. The lender approved proposals to raise up to $1.87 billion via equity and debt. Its debt issuance will be in both local and foreign currency. It did not specify what the funds would be used for, but the Indian private bank is in the midst of a restructuring since running into trouble with regulators 8 years ago for underreporting bad loans. It received a lifeline last month when Japan's Sumitomo Mitsui Banking acquired a 20% stake in it to become its largest shareholder. And Adani Airport Holdings is considering bidding for ground handling services at India's Mumbai and Ahmedabad airports. This move fits with Adani's plan to grow into related businesses. They are trying to fill a gap after a Turkish company, Salibi, stopped working in India. Salibi's security clearance was taken away because of national security concerns after Turkey supported Pakistan in a recent conflict with India. Checking on shares of Interglobe Enterprises, that's the parent of airline Indigo. The stock up just fractionally, 0.4%. At the IATA AGM in New Delhi, CNBC's Monica Petrelli spoke with Indigo CEO Peter Elbers about the airline's growth plans as well as its position inside India's aviation land space.
I think we've left that station of being a classical LCC already some years back. And given the size of India and the potential of India and the market nature of India, where Indigo operates from all the key cities, where we do have cargo, where we're developing a loyalty program. We do all these things where others say these are not classical LCC. But we have a, let me call it, fit-for-purpose airline. And then if you see the change of the country, the India of today is markedly different compared to the India of 18 years ago. And we know that the India in 5 years from now, by 2030, is going to be another more developed and more prosperous and more connected India. So if you take that journey, we feel that the long-haul space is a place also for us to be taken. So we keep the very foundations of our cost leadership in India itself. That will allow us to continue to build our network, to offer travel opportunities to millions and millions of first-time flyers, but at the same time also addressed that long-haul market, because for a long time that was actually left to non-Indian operators. So the opportunity for us to enter that space is just enormous.
And I want to talk about the SAF issue. You talked about that yesterday in a panel. You said Indigo's not doing it, and it wouldn't make sense to buy it, put it in a tanker, ship it over. That's not sustainable. And then you also mentioned even if India was producing it, it would be at the detriment of other elements. But then we heard the Minister of Civil Aviation saying that India has targets in place. So I wanted to ask you, it felt that these two goals were misaligned. So I wanted to ask you to clarify.
Well, thank you for bringing that up. That gives me the opportunity to clarify indeed. I think there's probably three different dimensions to that. One is the short-term dimension. That's the one I refer to. Today it's not there. So for my view, it doesn't make any sense to ship it from the rest of the world to here and say, hey, we also do it. It's probably nice marketing, but it doesn't help the planet. It doesn't help the cost levels. It doesn't help for pretty much anything. So that's today. Tomorrow and the day after tomorrow is going to be another story. I think the short-term story there is, yes, there's also going to be some SAF production in India. That's exactly what the Honourable Minister of Civil Aviation said yesterday, and he was lining out the ambitions. And I think for India to start moving in that direction is part of a more global approach. In the long run, I think that's the point I was making also, so I guess I addressed the first point, I addressed the last point, but not the middle point where the Honourable Minister was putting some emphasis on. In the long run, I think the challenge is SAF, if you really want to scale up to 25+%, it will go at the decrement of some feedstock. And I think a more holistic discussion is what is a reasonable and realistic objective and what are the exact consequences of that, especially in a country which is growing in terms of population, whereby the need for food production is huge. So in that sense, I think a holistic evaluation and probably a pragmatic evaluation of some of those targets would be needed.
Understood. Indigo is also said to be the newest and the youngest member of the $10 billion club, a very elite and small club. So you're in the club, but how difficult will it be to stay in the club?
Well, that won't be too difficult to stay in the club because we came in the $10 billion revenue club by actually our financial results over last year, which we released 2 weeks back. And looking at the growth, Indigo is going to double in size by the end of this decade. So we move from 400-ish aircraft we have today to around 600. So we have some in and out flux. And that means from like 100 million customers to 200 million customers. So against that backdrop, the revenues should continue to grow. And what precise percentage and what will it do to profitability, that all is sort of work in progress and our responsibility to make it work. But I'm a firm believer that Indigo will stay in that club because our growth and all the aircraft, the 885 aircraft we've ordered, are exactly supporting that growth.
Monica Petrelli speaking to Peter Elbers there. One last look at the Asian markets, where we are seeing a fair bit of diversion on the positive end of the ledger. Post-election and the successful election victory of President Lee Jae-myung, Kospi is up by 2.5%, TAIEX up by 2%. However, on the negative end of the spectrum, Thailand is down by almost 1%, and the rest of the Southeast Asian markets are looking rather flat. That's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is coming up next with Access Middle East.